Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, the regulatory space, capital markets, and digital assets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Sal Bruno, investment strategist with Nasdaq Global Indexes, and Ryan McCormack, factor and core equity strategist at Invesco. We're here to discuss where Nasdaq 100 valuation stands following the market sell-off and how it compares to historical multiples. It is great to have the both of you with us. Welcome back to Trade Talks. Ryan, not today's opening rally witstanding, there really has been some carnage in the market in general, not just specific to the Nasdaq 100.
No, and it seems like kind of nowhere to hide. Almost when you look at the Nasdaq 100, of course, it's been a really rough week. But even before, it was like the slide had kind of started in the last week of March. We had that news that Microsoft was kind of canceling or walking away or deferring some of the leases on data center build-outs. Now, from that report, right, it was kind of reported that in the EU, Meta picked up some, Alphabet picked up some, but you look at sort of the semis action from March 24th on, and it's been challenging. So it's like they already were starting off on a tough foot, and then April 2nd came along, and I think from that point there was really nowhere to hide.
Sal, we were talking about this off air before. ETFs made up 43% of all equity trading yesterday. That's only the only time it was higher than that was November 2008, which of course was the financial crisis. What do you think that signals? The volume of ETFs that were involved with trading?
Well, I think a couple things. Number one, it kind of shows the importance of the ETF as the vehicle, and then the acceptance that it's gotten. And two, a lot of the ETF trading tends to be more retail oriented. So we think that sort of has a look into, is it a buy the dip mentality that's sort of been drilled into the retail investor's head and I've gotten calls and texts from friends when the market's down 5%, should I buy? I'm like, well, I'm not going to give you any financial advice on that, but I think there is that mentality that if something it's down 10%, okay, it's 10% cheaper than it was, I should buy it. So I think that gets to a lot of the ETF volume that we saw.
Yeah, I got a text
buy the dip mentality
from my brother like 8, 9 o'clock last night. And I mean, even this morning we're seeing the market, it's 12:45 now, we're seeing the market come in a bit. But Ryan, the question is, and we saw this trade in the beginning of the year where emerging markets, European markets were outperforming U.S. markets because the valuation, the risk was to the upside there, right? So from strictly a valuation perspective with the Nasdaq 100, does it start to get interesting on that basis alone?
I think it does, right? And we saw, it took a little while to play out, but we saw it in 2022, right? We ended 2021 on a trailing 12-month basis of around 41 from a PE perspective on the Nasdaq 100. And then, of course, 2022, we're down over 30% on the index, and we really saw those valuations come in more kind of in line of where the index has traded, at least over the past 17, 18 years. Yeah. We're seeing kind of a similar trend here. It just seems to have accelerated. It's happened much quicker, where we're at about high 27s on a trailing 12-month basis, on a forward basis, just shy of 22. And so you look, relative to the past 5 years, right, on a trailing 12-month basis, looks like about an 11 to 13% discount. It's over 23% on a forward basis. Even going out 10 years, right, we're at a very slight, maybe 1% discount on trailing 12, but still a double-digit discount, around 10% on the forward side of things. Yeah, so, right, that conversation, in essence, I mean, we hear the calls, previously about like, I'm a little bit worried about these valuations. I think that story has kind of got flipped on its head a little bit.
And the interesting paradox is, when we really started to get into that AI conversation November 2022 and on, and how that really was the catalyst for the performance in the Nasdaq 100. It's interesting, you're questioning valuations when things are sitting at such high multiples, and now it's coming back in, right? So, if you loved it when it wasn't trading at a discount, it starts to become attractive at some point.
Yeah, no, I think so, and I mean, we were talking just before. We're looking at kind of where analysts are landing, just on a forward basis, and I mean, we haven't seen a tremendous change in terms of projected growth rates for earnings this year or next year. I mean, we're still sitting at over 21% projected growth for this year, over 15% for next year. So I think as we have earnings season coming out in the next couple of weeks, maybe we see adjustments depending on how many companies decide to issue guidance. But at present, I think pretty robust fundamental growth projections, and that kind of flows through to multiples, and I think if all kind of stands equal, it starts to look attractive.
So that really is the outlier. That's the variable there, right? It's going to depend what comes out of earnings. So even today, while there was quite the reversal, it doesn't feel as if it's a reversal of a trend or the market improving from here. it's going to be hard from an operating perspective to determine what forward guidance is going to look like until there's some clarity, whether it's good or bad, right? You just need to understand what that environment looks like.
Yeah, and that's something we started looking at. So the Nasdaq peaked, Nasdaq 100 peaked February 19th. And as it started to sell off, we hit correction territory. We kept a very close eye on, well, were earnings starting to, even before kind of the April 2nd tariff announcements, we wanted to get a feel for our earnings starting to come under pressure, and they really weren't. In fact, we saw upgrades in the earnings estimates from NVIDIA and from Broadcom, and they brought the earnings actually up a little bit for the index as a whole. That's sort of flattened out, so we're kind of at the same level now. If you look at forecasted earnings today as they were on February 19th, they're basically exactly where they were for the index level. So we haven't really seen any deterioration yet. We think there's a couple reasons that could be at risk, but I think analysts have not changed their estimates yet because A, there's not a whole lot of clarity as to exactly what's going to happen with these tariffs. There was a rumor yesterday that maybe they get delayed for 90 days. That caused some variation in the market for the day. There's also, will there be negotiations going on with certain countries, and will some of these tariffs actually get rolled back for those countries that are willing to negotiate with the U.S.? So there's that, and then I think there's also just not a whole lot of clarity into what the earnings are going to be. We'll start earnings, the first earnings announcements come out tomorrow. I think Delta is the first company to announce. And there will be a lot of emphasis on looking forward, right? They're going to be reporting first quarter of 2025. I think that's going to be discounted quite a bit because we think the world has changed pretty significantly on April 2nd. So everything they're reporting is before the world kind of changed from the tariff announcement. So it's going to be very curious to see who's willing to actually step out and make a forecast and give some forward guidance. Maybe they give a best case, worst case kind of base case as opposed to really giving guidance of where it's going to be, and then we'll have to see how the analysts pick that up and how that flows through to the actual earnings estimate.
Yeah, and so for the economists as well too, especially when you think about travel companies such as Delta and travel and the services part of the economy is such a big part of consumer GDP and spend here in the U.S. Of course, making 69–70% of it. So what's that going to look like if consumers are cautious because they're expecting prices to go up 10–20%? What does that mean to the discretionary spend? So I think not just looking for keywords, but trying to figure out from management teams how they're perceiving the economy and the consumer.
Yeah, I think they have to, right? And I think I think it'll be very, very telling to see what these early kind of movers, early announcers are willing to say. How impacted will their business be, or how impacted are they modeling their business to look like? I think another thing that we should probably look out for without the guidance is sort of the reiteration of CapEx spend.
Yes.
Right. So I mean, we've talked about previously. Google or Alphabet had sort of reiterated that $75 billion number. Even despite the Microsoft news, they noted that they were on track for their $80 billion of CapEx spend for the fiscal year, which ends in June. So I think a reiteration of CapEx spend, specifically around maybe data center build out, around AI infrastructure investment, I think that would go a pretty long way, at least for some of those kind of sub-industries within technology.
And we were speaking about that when we met in March, that really was the key, because I think I had asked you and Ryan at that point, because that's such a big indicator for Nasdaq 100 companies. They, historically spend more on R&D, and that's translated into their earnings and into their growth numbers. So I think that's going to be an important, part of the calculus for the index. Are there any bright spots in the index? Any outperformers, whether it's stock specific, sector specific?
Yeah, I mean, what's interesting is through March, 7 of the 10 ICB sectors that Nasdaq 100 has exposure to was in positive territory. Now, since March 24th, only 2 names in the Nasdaq 100 have been positive. That's Exelon and Mondelez International. Since then, like I said, there were not really too many places to hide. But I think in general, you've seen some of the more domestically oriented utilities have fared better than most. Healthcare, some of the biotech names within the Nasdaq 100 have done pretty well. A name like Amgen, a name like Gilead. T-Mobile has been a standout in terms of relative performance against, say, the S&P 500, or even O'Reilly Automotive, right? When they rolled out the auto tariffs, it was, well, I think more people are going to be picking up a hobby on working on their cars, right? So we kind of saw O'Reilly be sheltered a little bit. So there's a couple of pockets, but I think what's interesting is the growth of the Nasdaq 100 ecosystem, right? So we launched an ETF, of course, based on the Nasdaq 100 Low Volatility Index. Through yesterday, Nasdaq 100 down, over 17%. The Low Volatility Index and our ETF QQLV only down 1% for the year.
Oh wow!
And you see it kind of gravitate towards some of the more consumer staples oriented. Of the Mag 7, Microsoft is included, which hasn't fared too well, but I think in comparison to some of the other larger names, has held in pretty well. So, as we look at kind of how you slice and dice the Nasdaq-100, you can kind of maintain similar exposure, just with a different look and feel.
That's like a great portfolio diversifier.
Yes.
That's a big disparity in performance. So while you might not capture on the upside during a recovery,
Yep.
It certainly does lend to the power of diversification, which we're all taking a crash course in right now.
Absolutely.
There's a generation of investors who have not experienced prolonged volatility.
Yeah, for sure. And just to reiterate your point on the consumer staples, I mean, if you look at some of they're still down, but not down nearly as much as some of the other names. It's been the consumer staples, it's been beverage companies, it's been food companies, Heinz Kraft, Mondelez you mentioned, Coca-Cola Enterprises, Keurig, Dr. Pepper. Those companies have actually fared much better than sort of the broader index. So it's been the consumer staples, less affected by some of the tariffs, have more resilient consumer bases.
I mean, you got to eat at the end of the day,
Absolutely.
right? I think the challenge is going to be there, how much can companies pass down when it comes to the tariffs? Because those companies do operate in thinner margins than, let's say, relative to the tech companies, and the consumer is just, they just got blasted from inflation over the past 5 years from COVID. So it's going to be almost like an investor relations balancing act when you're thinking about passing costs down to the consumer. I think that's going to be another interesting tidbit I will be listening for from earnings to see how they plan on managing any perceived input costs.
Right, we're going to have to keep an eye on what happens to margins, because that's where it's going to show up, is on their operating margins, right? If their costs are going up and they're not passing them down to the consumer and they're absorbing them, it's going to hit the margin. So it's got to go somewhere. It's like squeezing on a balloon. If you squeeze on one end, it's got to come out the other end.
Well, I wonder if companies get a pass on that, because the market's expecting that someone's going to get the cost passed down somewhere.
Yeah.
Their companies are going to absorb it, or the consumer it's going to get passed down to the consumer, and then they spend less.
Yeah.
So something's getting cut somewhere.
And I think historically, like the mind goes right to, well, it's just going to get passed down. But to your point, right, this seems like, anecdotally, a pretty exhausted consumer, given what's gone on the past 3 years. So maybe a delicate balancing act where some of the costs get passed on, you eat some and bite into your margins. But again, I think this round of earnings will be highly scrutinized, and probably more so on the earnings call rather than pure Q1 performance.
Yeah, it'll be interesting, our conversation in May, that's for sure. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.